Welcome back in, everybody, to Compounding Capital, and there is a lot of things going on, and if you've been subscribed to the channel, guys, you've been well ahead of all this. This is going to be a pretty substantial pullback we're going to see probably over the next few days, but I do think Nvidia could actually surprise to the upside, regain some confidence in the market. And if we go off of our last video comparing 2007 to where we are today, the first rate cut that is coming should be a bullish move here. So that first 25 basis to 50 basis rate cut that the Feds are going to indicate is going to be a bullish move. And we normally get about a 15 to 20 day rally following that. But economic data is absolutely in line with what I keep saying, guys. First quarter of this year, first quarter of 2025, I do believe we'll be in a recession. So let's get into the action that's taking place. And I also want to talk about the opportunities that's taking place. I am not trying to be bullish or bearish. I'm trying to be as open-minded, as neutral as possible, and look at everything as a whole and see where opportunities are. So that's exactly what we do on this channel. And normally we do it from a fundamental analysis, but we also want the charts to line up. When we get the charts and the fundamentals lining up, that's where we get beautiful price action, and that's where we get really good appreciation and return on investments. So as we all know, Nvidia is going to be reporting earnings today, but a few different things have happened. Number one, Buffett's Berkshire Hathaway hits $1 trillion market cap, now part of the $1 trillion club. And honestly, this should be part of the Mag 7 here. I think we take Tesla out, put Berkshire Hathaway in, and I think we're on to something. And the NASDAQ leading the downward move here at negative 1.22%. Russell also underperformer with down 0.5%, and the VIX is starting to pop back up. And this is what we said, the VIX is now going to be something to keep an eye on. That volatility is going to be here to stay throughout the end of this year, and we're going to see crazy price action. As I stated before, I do think we still might see a new high in this market before we go into recession. Now, what's the big thing taking place today? A lot of big things taking place today. Interesting stuff coming out with Supermicron. Now, there is a massive short seller on Supermicron saying their accounting is very cloudy and misleading to investors. And so Hindenburg does have a pretty substantial short on it, which has caused the stock to go down. And now Supermicron all of a sudden has decided to delay its annual report as this short selling report has come out. What is the stock doing today? The stock is down 25% after this news. People are starting to get scared. Now, this could be an opportunity. Personally, I think the valuation is pretty interesting here. I think the market cap's pretty interesting here. But when you start talking about accounting fraud, then we got some serious problems here. So probably one I would stay away from until the dust settles here, but could be a buying opportunity if things clear up and the short actually gets closed here. But take a look at this price action. This stock was trading close to $1,200 not that long ago, and now has fallen off of a cliff down to $400 a share, and it's probably going to go lower than that, as once it breaks that 4, more short sellers are going to come here and push it down lower. When we think more macro, ladies and gentlemen, what is taking place today? Well, take a look at that 2-year treasury sitting at 3.8%, a little over 3.8%, and the 10-year treasury at 3.827%. And what have we been talking about on this channel? What we want to watch for is yields starting to normalize. What are we seeing? Yields are normalizing. Markets are starting to get a little dysfunctional here, and that's absolutely in the cards. But with that first rate cut is going to be, I believe, a blow off top, a sugar high for about 15 to 20 trading days. With volatility comes great opportunity. I'm going to talk about SJM here, Smuckers. Now, I've done multiple videos on this stock, and I think it's in an interesting buy zone, anywhere between about 105 to right around 110 a share, and it got as low as 113 today. Pretty substantial sell-off for a consumer staple when you're factoring in, a 5-6% move on a consumer staple. But I actually thought the report was pretty interesting here. It opened up a lot of different things that I think we really need to consider. And so let's talk about this earnings report. So Smuckers to me is a very, very important indicator of the consumer. Everything from peanut butter and jelly to dog food to snacks and coffee. Okay, so when we think about how many products this company sells, it's a pretty interesting diversification within their products. And this company trades for a pretty substantial discount compared to its peers. Now, Smuckers did state that consumer is slowing down. We're starting to see a shift in the consumer that's kind of alarming to them, and that brought fear into the stock today, which is why it's down. But they absolutely smashed earnings. Guidance is the problem for Smuckers today, okay? Instead of 10% growth, they're looking at 8.5 to 9% growth. But the one thing is they did give us some guidance here. They're saying they're going to do right around $9.60 to a little over $10 of earnings. So let's kind of figure out what's going on. So let's kind of figure out what we're looking at for a forward PE standpoint here. So I'm going to err on caution and say, the stock's trading right around 113 a share. We divide that by the $9, we'll call it $9.65 because they said they're going to do anywhere between $9.60 to right around $10. So we're looking at an 11.7 PE ratio on a forward basis on a company that's still going to grow around 9%, which, this is a very, very safe place to hide in when we're talking about what if we do go into recession. I love the footprint of their business. They basically own the at-home coffee market. They own Folgers, Bustelo, Dunkin' Donuts brands. So when we think about the commodity of coffee being really expensive, and that's another reason why the stock is down, how is that going to impact a Starbucks? If inflation is finally eroding the consumer, then they're going to start making coffee at home, which is going to benefit a company like Smuckers. And they're giving us guidance. It's not like they're wiping guidance out off the table. Yes, profits are going to be pretty slim because of the commodity prices, but they're still projected to grow revenue between 8 to 9%. And they're only trading at 11 times earnings. And the thing that's great about this company is if we look at yields coming down, we go back to the yield market here and you say to yourself, well, if you got a 7 to 10 year time horizon and we start looking at the yields from 7 to 10 years out, you're looking at 3.7 to call it 4% yields with no capital appreciation or no growth, where Smuckers is offering 3.5% yield, which they just raised their dividend. You're looking at close to a 4% yield on Smuckers here if they keep raising their dividend and they keep growing their earnings. And you're also getting the appreciation of the actual stock, buying it on a discount here. And historically, it's trading pretty cheap. We can see, it's trading at basically 1 year lows or floating right around 1 year lows here. Basically when we look at the valuation of the company trading at 11 times forward earnings, paying nearly a 4% dividend, it's still growing that dividend, still growing its earnings. So that dividend's going to be safe. And that they could keep growing that dividend consistently in the foreseeable future. The stock's down 20% on the year. And this is a stock that was trading closer to $150, $130 a share. So at these levels, I think it's a pretty low risk. I think the stock is de-risked, and I think it can outperform in a down market. And even if it doesn't, even if it just stabilizes, you're basically buying a 4% yield at these levels with earnings growth still around the corner. As they stated, they're still going to be able to grow top line revenue close to 9%. And we know what they're trading for. They're projecting out right around $9.60 to possibly $10 of earnings. And if you get it on the higher end of $10 of earnings, then you're actually buying a stock that's trading closer to 10 times earnings. So I think this one's uniquely positioned after this sell-off, and I do think it'll start finding a bottom probably closer to that 105 to 106 mark. And we've done analysis on Smuckers, so I want to pull that up really quick. So from a free cash flow standpoint, I like it at $136. And from a multiple to EBITDA, we have a roughly an $81 price target on that, with a fair market value sitting at 2031, sitting at $160 a share. Now, their growth rates are actually a little bit better than I put in here, so I'm going to bump up the growth rates a little bit. So I do think it's probably closer to a floor of around $91 a share. And, it could be from a free cash flow standpoint, once we get through some of this high inflation, high commodity prices, and we go through deflation, this is a company that probably could be trading closer to about $140 to $150 a share. And right now, if you buy the stock, you can be locking up close to a 4% dividend yield, which is very comparable to the longer end of the yield curve here. So I do think that this is pretty interesting. I do think that the de-risk after today, the sell-off today, might be a little bit overdone. This is a company that, I think is going to be completely fine, probably going to do actually better in a recession when we think about the footprint on coffee. And I actually think with them giving us the warning on the commodity prices, this should be a red flag for companies like Starbucks and possibly even Dutch Brothers. If commodity prices on coffee are going higher and it's ruining the margins. Now, think about a company like Starbucks where they have to pay staff. They have to keep the electricity on. They have buildings and leases, where a company like Smucker's is direct to grocery store, so it's not as much overhead for them to really wheel and deal prices. So when you buy 1 cup of coffee at Starbucks, you could essentially buy a whole canister of coffee at a grocery store, which will last you, probably a few weeks versus just 1 day. Everybody's waiting on Nvidia, and obviously everybody is nervous with what we just saw with Supermicro. Stock's down 25%. And what is concerning about Nvidia is the valuation is obviously could be in line, but if they have any hiccups, the valuation could be very, very rich, and we could see this thing whipsaw back down. But the concern with Nvidia is the rumors that are flying around here that Nvidia did not deliver the Blackwell GPUs, which could impact this quarter's earnings. Now, with that being said, if the sell-off gets really overdone, this could be an actual buying opportunity for Nvidia. I can't even believe I'm saying that, but if the demand still stays high for these hyperscalers and they do deliver these GPUs, but they weren't delivered on this quarter, well, it's going to show up on the next quarter, which means next quarter earnings could actually really outperform. So if we get that initial knee-jerk sell-off, then we could absolutely see an opportunity to possibly buy Nvidia. That's not a recommendation for me, guys. I'm probably not touching it at these levels, to be quite honest with you. I'd be leaning more towards defensive names like Smucker's, or even possibly some of the healthcare positions that I've talked about before. But just wanted to give you kind of the insight of what's going on in today's market. Now, the shock to me is crude oil still selling off here. I really thought we were going to see a bid under crude oil with the fact that all the tensions going on in the Middle East. If we have such a strong economy, demand's going to be there for the summer. And what this is telling us is that demand destruction is absolutely in place for crude oil. And so that lines up with our thesis of us going into a recession. If everything is so strong and everything is so good, why is crude oil selling off so much when we have tensions in the Middle East and demand should be high for our economy with everybody flourishing? And so crude oil is telling us a different story than what the actual market's been telling us. Along with that, when we think about the absolute rip your face off rally that gold's had over the last 12 months, tells me that this has been a flock to safety and that there's huge inflation still taking place with the amount of printing going on. Now, the gold miners have been catching up to gold, and this was a trade that I've talked about a lot on the channel. You can see here they're down roughly 2%. They're going to have a little bit more beta than the actual underlying asset of gold. But this is actually an area where I thought we should see new highs in the gold miners, right? It makes sense. The actual commodity that they're mining for is at all-time highs, but yet on the 5-year chart, GDX is only up 5%. And it's starting to formulate an uptrend here. And so maybe this is just a nice pullback to possibly buy for GDX to hit new highs. That could be an interesting trade as well. And so we can see when we look at an all-time high for GDX, it was over $60 a share. It's only at $38 a share. So this could be an opportunity as well when we think about the possible return on the gold miners. The gold miners could still be in a buying zone here, even though they're hitting, relatively highs over the last 5 years. But I take a look at Barrick Gold, and this one to me is well positioned, well capitalized, great balance sheet. I like the diversification. I like the acquisitions. Little small dividend here of nearly 2%. This is one that I bought at $13 and sold at $17, and I wish I would have held. As we can see here, it's at $19 pushing $20. I think it got as high as nearly $21. It's been in this downtrend that it recently has broken as well. So a lot of things to like about Barrick Gold as well. So that I think these are some things that you want to kind of keep in the back of your mind if you think we can go into recession. So we're thinking consumer staples, maybe some healthcare, maybe some gold miners. These are some contrarian type plays. I brought up Mosaic before. I think that's another one you might want to look at, that possibly being defensive. With the dollar weakening and fuel costs going down, Mosaic should actually have a lot of tailwinds for their earnings to actually be a lot stronger than what's being priced into their stock. We take a look at a 5-year chart of Mosaic, and it's basically starting to reapproach these 5-year lows in a time frame where I actually think they should be excelling. If you're not sure what Mosaic does, they're one of the largest producers of fertilizer. So with the amount of population growing, and I think we're going to be a lot more reliant on domestic farming. They have locations all throughout the globe. So this is one I also find interesting as well. Just wanted to kind of come on here and go through everything that's taken place. So we're really waiting on NVIDIA's earnings. If NVIDIA really disappoints, then I think market sentiment is obviously going to be pretty downfall here. But if NVIDIA's earnings are strong, and I think this could actually stabilize the market once again, and once we get that Fed rate cut, we know September is usually a tough month for markets, but once we get that rate cut, I do think that should whipsaw markets back to the positive. Of course, this is all just my opinion and going off of what I'm personally seeing, but as always, guys, appreciate your time. We will see you in the next one.